Welcome, everyone, and welcome to Rethinking Balance Sheets. Ravi and myself will be having a guest today who will be joining us. And just to get up and running, let me get Ravi in. Ravi, how are things? And last week we talked a lot about SMEs and the need for funding and how they can go about getting this funding. Maybe you want to very quickly, in about 30 seconds, just summarize some of the things we talked about last week.
Okay, I think you just reminded everybody, we talked about, keeping your reputation intact, with the bankers and bank financing. But I think we concluded very much, in this market, it's going to be difficult to get bank financing. And what we hope to do, Roshan, is, get people who are non-bank financiers onto the show going forward. But, again, I suppose one more thing that you can look at if it comes down to it is that assets and looking at your balance sheet should be selling stuff that doesn't make sense to be on your balance sheet anymore. Perhaps it doesn't mean that this is stuff that we're going to talk about, which is for bigger companies. Always, I keep saying is it doesn't mean that stuff that's only involved for large corporation. It's not 100% you can't use it for smaller companies, right? So I'm saying that let's have a chat about on the asset side of the balance sheet, there's stuff that needs to go out or stuff that needs to come in. And even I think there's been a lot of talk in the oil and gas sector, steel industry, on consolidation because they've had difficulties, right? Does it make sense for two smaller businesses to get together, to see they can, ride out this crisis? Maybe that's something that we can talk about. And in that sense, I think we're very lucky. We've got Philip here joining us this morning. Philip joined Stage 3 a few years back. He's also one of the executive directors, done some fantastic work for us in the more recent transaction, selling the drilling business of Presci, which was brought up by Icon. It's been well reported. Obviously, he spent years with Rothschilds and all in Singapore, many of the big major investment banks in Singapore, and done a lot of regional work. We are obviously privileged to have him on the show. He can give some great insights. And I think back to the same thing, it's not what we want to push out here. This show is out there for the community. That's the back.
Yes.
So we hope the community will be asking questions, yeah?
Yeah, so before we get Philip on, I mean, let's talk just very, in a short time, M&A is something that, many organizations, I guess, haven't really thought about. But I mean, in this time of crisis, it's an option, right, to be talked on a little bit. So Ravi, 20 seconds, your thoughts on why we should be talking even about M&A, and then let's get Philip on the show.
Okay. One of the things that at least we've been involved is on, at least my side, but this is again larger side of things, right? On the oil and gas, I think there have been pronouncements there should be mergers, and simply even on the steel industry, and that was driven much by distress. It never really happened. A lot of it never happened. We've done quite a few of them, and that only happened eventually. Like everything else that we've talked about is, the 5 stages of grief. And once there's real acceptance, that mindset says, okay, we've got to do something about it, then the deal gets done. No point talking about M&A, etc. When you even come to the fact that you want to do this and you've come to acceptance of that this thing is necessary. So come back to that mindset thing. Yeah. All deals get done when you get to that acceptance stage. Yeah.
Fantastic. So let's bring Philip on. Philip, welcome to the show, and super glad to have you with us, Philip. We're going to talk a little bit about this whole concept of pedal to the metal or foot off the pedal in terms of the M&A piece. And I want to start very quickly by just asking you very simple questions. Because as you think about it, why at this point in time should M&A be something that we should be looking on? Why M&A?
Okay, thank you, Roshan, and thank you, Ravi.
And more importantly, I think is this a good time for us to be doing that? Especially in this whole pandemic time.
Sure, all very valid questions. As an ex-investment banker for about 15 to 20 years, no matter what cycle you're in, there are always opportunities. Just that perhaps this pandemic, when it first appeared 12 months ago, heightened the whole process here for M&A, if you ask me. 12 months ago, when it did appear, there was almost a perfect storm. there was cross-border tensions, if you remember, between the US and China. Then you also had the oil and gas crisis, and the effects of which many companies are still reeling from the impact. Now, for today's talk, I'd like to share with you some of the transactions that I've had the benefit of advising on, and also look at what's in the marketplace that has been recently in the some of the transactions which have been taking place in the marketplace.
Sure.
Many of these transactions are relating to public listed companies, but what I can say is for many of these transactions, they could equally apply to SMEs. I mean, maybe the deal sizes are smaller, but the principles of M&A will still apply equally to these private companies. Now, going back to your question, is it a good time to look at M&A? I think there's probably a very heightened need now because in my mind, I think there's an acceleration of it brought on by a few factors. First and foremost, if I could say, for companies which are capital intensive, they may be in financial distress, and this would be a perfect reason for M&A. The whole process of M&A should be driven by factors like what's the compelling need for these companies to survive, right? So one of the transactions that we have recently concluded in January was the sale of the drilling business for Perisai. They definitely were in financial distress, and one of the ways in which they could pay down the debt here was they had to sell off the oil rig, the drilling business to Icon. So that was something for which we handled and concluded successfully. Now, the next reason which I would say is the valuations. They are now moderating, and they tend to be a little bit more attractive. Not long ago, I think about 8 months ago, Bangkok Bank acquired an Indonesian bank from Standard Chartered and PT Astra in Indonesia. Now, when it first got announced, Bangkok Bank was going to go ahead with this transaction, but then changed its mind when COVID appeared. Standard Chartered was still very, very keen to sell it, and what did they do? They dropped the price, and Bangkok Bank managed to pick up Bank Permata for a very, very reasonable price for a market which is fast growing. So, as I said, valuations tend to moderate and become a lot more attractive.
Yeah, and I think, Philip, that's true also when you look at the SME space. I mean, one of the things I think, in my space, the training space, we see tons and tons of companies, and they had this unrealistic valuations of themselves. But I think COVID has sort of brought reality back in some way or form. So people are a little bit more reasonable when you have dialogues, in terms of M&A, in terms of consolidation even. So I think you're spot on there,
Yes, definitely, because when the hurting is gets really acute and the pain sets in, you really have no choice, do you? And what are the ways in which you now need to employ to survive this crisis, right?
Absolutely.
As Ravi always keeps reminding me, never waste a crisis, right? So do what.
Yeah, Ravi just loves crises, right? So try.
Moving on to one of the factors which are driving M&A is also the consolidation. Yeah, the weaker players, especially in the oil and gas space, the weaker ones will drop out, and the ones who are better capitalized will be able to ride this through. Now, I think what's happening in the marketplace, you can see quite apart from the transaction that I shared with you, the Icon and Perisai transaction, the recently concluded Felder FGV transaction too. In my mind, I think what Felder did was rather opportunistic. Share price was very low, but the intention to privatize in that instance wasn't successful. Although they did manage to creep up and increase their stake to 81%, but the privatization fell fell flat. So maybe they might revisit that again. But since the close of the offer, we've seen share price rebounding from the 130 offer price to, I think the day after the offer closed unsuccessfully, it reached almost 160. And that's also on the back of the crude palm oil prices, which had increased, which wasn't quite factored into perhaps the felder of a price. Yeah.
Yep.
Now, I think Sun Tzu says it best when he shows that when there's danger, there's opportunity, and it's very much captured in the Chinese saying "危机." Yeah. So the crisis is here. There are many opportunities which have surfaced, and the willingness to come to the table to talk is there. Okay.
Yep. And I want to talk about strategic acquisitions, right? I guess it's an opportunity to look in a broader capacity at this point in time. You talk a bit about consolidation, and you talk a bit about and I see that across not just in the oil and gas, right? I mean, see that across many industries, right? Because there have been, especially the fragmented industries where there's a bunch of players, and now the cost of doing business becomes a lot more, I guess, expensive to some extent. So talk a bit about this whole concept of is this a strategic acquisition in terms of how we can ensure that happens?
Yes, Roshan. Actually, the previous slide when you asked, is this a good time to engage in M&A? For me, the more pertinent question really is,
if you
is
don't
this
buy,
a strategic acquisition? Does it make sense to you? The question by then saying, what if you don't undertake the transaction? What happens?
Absolutely. Yeah. No, that's absolutely spot on. Yeah. So go ahead. Yeah, you answer that question too.
Now, there are many reasons for acquisitions here, but strategic ones are always the best, of course. Now, I'll share with you the example of Sampurna cigarettes in Indonesia. Actually, I've got quite a lot of examples from Indonesia because I spent about 5 years in Indonesia as well. Sampurna cigarettes, was bought by Philip Morris quite a few years back, and for Philip Morris, for all you smokers out there, is famous for Marlboro. Okay, now they saw this opportunity, and if they didn't undertake this acquisition of Sampurna cigarettes, what would it mean for them? Well, the competitor could well swoop in and acquire Sampurna, so it was almost like a preemptive move here. But there are many other benefits, of course, here. I mean, Indonesia is a fast-growing market, and they saw a great opportunity to really get entrenched in Indonesia. For the Sampurna owner, it was very clear for him. He saw a lot of headwinds coming forward. All these environmental issues with cigarettes, health issues, increasing duties. So for him, it was a bit of a no-brainer. So he just sold, and the offer price on the table was great. You have other reasons as well. Market share, the next example I have. This one is very much in in Malaysia. The name is, of course, very well known to all, Old Town White Coffee. I think about 3 years back, it was bought by the Dutch company JD Ekbergs. JD Ekbergs had no presence in Malaysia. It has presence in Singapore and maybe other parts of ASEAN, but not Malaysia. So this was a great opportunity for them to get to expand geographically. Scale is also another good reason why companies go into M&A. They want to bulk up. They want to add, by bulking up, you also get economies of scale. And KL Kepong, they were acquiring further plantations. And, KL Kepong is one of the biggest palm oil players in Malaysia, right? But that didn't stop them from acquiring more. So, you just add scale. Yeah. The next, yes, Roshan. Roshan, you wanted to ask me something?
No. I think go ahead. I'll keep that for. Go ahead. So you're talking about extending the value chain as the next piece, right?
That's right, extending value chain. Now, for Icon offshore transaction, for Icon, it's very clear too. They were in the business of OSVs, or offshore supply vessels for the oil and gas industry. And this acquisition made sense for them because it was a really vertical integration here. Buying that oil rig and the drilling business allowed it to offer a wider suite of services to the oil and gas sector. Okay. Now,
Yep.
the last point I have, the positioning for IPO, this is very relevant, I think, also to SMEs.
Mm.
Now, many SMEs probably harbor the ambition to one day list your company. Okay. In its present form, you may not meet some of the requirements for an IPO, like track record.
Yep.
uh, Acquiring another company, which could be synergistic to you, to yours, for all the reasons I highlighted just now. You get market share, you get scale, you maybe extend the value chain.
Yeah. Yep.
Then it makes your company look a little bit more interesting, sexier, and
Mm.
perhaps be able to then qualify for some of the requirements for an IPO on Bursa. That's it. It's not a case of you just acquire a target and you are able to combine it with your company and go out for a listing tomorrow. It doesn't quite work that way. I think Bursa would probably need a period of time to ensure that you demonstrate that under your stewardship you are able to have an interesting company which is stable and can go out and satisfy the listing requirements. Once the
Mm.
once the owner of the target exits. Okay, so
Right.
very
Right.
relevant for SMEs. I've come across this many times before when I was an investment banker. Companies do come and ask me, Philip, how can I go for a listing if my track record here is not quite there? So we give
Mm.
them some insights. Yeah.
Okay. Okay. And I think one of the things, I mean, we are, I mean, although I'm an SME, we are one of those at this point in time also considering acquisitions, especially in regards to building market share and extending our value chain, and to some extent positioning for a future IPO or acquisition. And one of the concerns, I guess, many of our shareholders have and many of our investors have is, that's going to impact the balance sheet. It's going to potentially dilute. Potentially there's some significant negative impact or things that we need to be worried about. Extending ourselves and gearing ourselves. Talk us through this. What some of these impacts on the balance sheet is, and how we can maybe mitigate some of these, or maybe it's lack of understanding on our side, where some of these things may not be as significant an issue as we think it might be, or at least as it's prescribed to be. So tell us a bit about this.
Those are very, very good questions, I must say. I mean, you thought it through a bit. The impact to you at the company, sure, there's quite a lot of things I can speak about, and what are the things which can impact your balance sheet. I think the first and foremost is, as I said, is this acquisition strategic? That's key. Assuming it is strategic, then you are able
Yeah.
to extract all the synergies that you want. That's going to be great, because when you do take on this acquisition, you have to think about things like, oh, where am
Yep.
I going to get the financing from? Now,
Yeah.
if you're so lucky to get your bankers to finance the acquisition, the immediate impact is the level of debt then which your company will have to carry, right? And you have to then ask yourself, do you have the means then to be able to service that debt? Now, if the target has got good cash flow from that would certainly help. So is the acquisition strategic? The other question that you need to be concerned about is, are you overpaying for the target? Because if you overpay, then the financing that you're going to carry is going to be hefty, right? And if you don't have a sustainable business and strong cash flows to be able to service that, soon you'll
Okay.
find yourself struggling.
Stretching. Yeah. No, that's true. Okay.
Yeah. Um, don't forget too, when you acquire a company, you also have to assume the target's borrowings.
Mm,
Um,
mm,
Sometimes you may get the target for cheap, maybe even a 1 ringgit, but it comes with a lot of borrowings, right? So which you got
right,
to
right.
sense of, and all that's going to be captured onto your own balance sheet once you consolidate the subsidiary.
Mm,
Again, you have to ask yourself, what is it that you go back to the question, was the acquisition strategic? What did you hope to do with this target, buying it for $1, but with a lot of debt here, right? If you were able to open up new markets, get new products out, the revenue just jumps on the back of that, and you are then able to service the borrowings, then that's great. But you do have to ask yourself these questions.
mm,
Um, uh, One thing which also comes to my mind when you're consolidating the accounts of the target, the receivables. Sometimes they may have a lot of receivables on the books, which may not be collectable.
mm.
So that's something you need to worry about, because
Okay.
once you
Because all these
consolidate,
get transferred. Yep, yep. All these get transferred over to you, right? Yeah.
and soon you find you can't collect it, and you have to write down. That's a big impact on your balance sheet. Uh, the other points that I would want to raise is shares being issued as acquisition currency. Now, uh, when you issue shares to acquire a target, that helps to strengthen the share capital.
Mm,
But the process, you do have to take note that your existing shareholders may get diluted. Um, PLCs use it all the time, using the shares to fund the acquisition. Sometimes they could use it as in a combination of cash as well as shares. Sometimes it's all shares. But these are the ways in which they could use to finance an acquisition. But it does have an impact too on the balance sheet.
mm. And
Now,
I think this is one piece in and especially here with SMEs and smaller organizations. It's not something fully utilized. Using shares as a acquisition currency. Why is that? I mean, is there certain things preventing it, or it's just a lack of education or understanding?
mm, um, for PLCs, it's very easy because the shares are quite liquid. It's
Yep,
tradable.
yep.
You have an exchange there where you can buy and sell. If you're a private company, it's harder, isn't it? Because there's no liquidity in your shares here.
And
There's
the
no.
valuation is subjective, I guess. Huh?
Um, I'm less concerned perhaps with the valuation, but rather the
The ability
ability to.
to liquidate. Yeah.
You just don't have a platform to freely trade this, if you needed to
Yep.
liquidate it, if you needed to sell your shares. So that's why a lot of SMEs also always think about, maybe the route to go here is to go for a listing in due course once I get some scale. Okay. The last point I'll make is, in any M&A, there's always an excitement and eagerness here to close a deal. You often really overlook many key considerations, which should be addressed in careful negotiations. Acquiring a lemon, if you don't do enough due diligence, for instance, you definitely going to paying a price, because later on you might have to make huge impairments, and then even your shareholders' equity may be badly affected in the process. So something you need to be mindful of. Always make sure that you don't overpay as well, which I will share with you one other point, and perhaps a word of advice here. Is just as important for you to be able to walk away from a deal as it is to conclude a deal successfully. You walk away from the deal if the economics of the deal doesn't make sense, or the risk itself is just too high for you to assume. Best if you just drop the deal, look at other alternative targets, or maybe wait until the target that you're now looking at reappears in the market at a more affordable price.
Mm,
So it's really important to keep that in mind. Never chase a deal. You might have a lot of competitors out there looking at it, and you think, oh dear, if I don't buy it, my competitor will march on me. But sometimes you just have to take a step back and be prudent, spend within your means, and make sure it really makes synergistic sense. Okay.
Okay, I think that makes a lot of sense, but it's very hard to do because I think many times we get emotionally attached to the deals, and it's so hard to be new. I guess to look at it in a very objective manner. So that's very sound advice, I think.
Oh well, I can only but suggest to you. Yes, the promoters generally get quite emotional. The principals get emotional. That's why sometimes they hire the professionals to give an objective view. They tell
makes sense.
and during my time as an investment banker, I've advised quite a few clients. Yeah, this is not the deal for you. You want to walk away from it. And thankfully, most of them did listen, and they lived to tell the tale. And whoever
Nice.
bought some of those targets paid a hefty price, and struggled after that.
Yep.
It can
No, and I can see that happening, but I think sometimes people just have a hard time. And so this begs the question, how do we minimize the risk? There's always going to be some risk involved. And how do we do it in a way that makes sense to really mitigate and minimize the risk?
Yeah. All right. I think my next slide probably will be able to shed some color on this question that you've asked, Roshan. The one that I frequently get asked here is, why is the owner selling the company? Now, understanding the motivation for selling offers a great insight on the urgency of the deal, how fast they want to do the deal. Also offers an insight on what potentially could be the pricing levels you could come in at to make that offer price. Now, for the sellers, there are quite a few reasons why they may want to exit. One of the ones that I recently encountered, and that was shortly after COVID appeared in our midst, March last year. There was a sale of a Thai glove company, and you probably ask, why is the founder looking to sell the glove company? It's like the flavor of the day now. Everybody wants to be wants gloves,
Involved in
right?
it, yeah.
Price is going to skyrocket, right, for glove companies. Well, the founders had a very valid reason there because they were getting on in age. They had no children which were interested to continue the business. So they were prepared to let it go. Now, I think the timing couldn't have been better because, of course, in the middle of that pandemic, all these glove companies, whether you're private or public, enjoyed premium pricing valuations. So as you can imagine, there was a long line of suitors all waiting to acquire this company, and premium pricing was extracted for that. Other reasons
Go ahead. No. So I guess I think that's a very important point. Sometimes the strategic fit is one, but understanding the motivation of both the seller and the buyer also is very critical. So I can so I think that's a very important point. I'm just trying to reiterate that point. Go ahead.
Another reason for the motivation is the business is what we call plateauing, is flat. And perhaps one good example is the recent Tesco sale in Asia. That was sold to the CP Group in Thailand, and Sine Darby benefited from this because I think they had a stake in Tesco. For Tesco, it's redeploying their funds to markets where they considered it core, and Malaysia was not core for them. The business, it makes some money, but it's not growing at the level which they wanted to. It was basically pretty flat. So that was another reason why they wanted to exit the market in Malaysia. The next one I would share with you, what are the headwinds coming up? I had one client here where he spoke to me, I think that was January 2020, again before the pandemic. He said to me, he was a property in the property business, but he also had an oil and gas segment in that group. And he wanted to exit the oil and gas business because he could see a lot of headwinds and challenges coming up. So, that was his reason for wanting to sell if he could get some value. On paper, it could have been around 500 million in value. Unfortunately, he was not able to do that in time. Pandemic did set in, and he couldn't get a good value for it. He's not desperate to sell, but that was one of his considerations. He wanted to sell, make sure he had a war chest to ride through the crisis which he saw coming in the next 12 months.
Okay.
Perhaps the last point that I would make is for many companies, they want to refocus on the core business. And one of the transactions that I did advise in Indonesia was for an Indonesian conglomerate to acquire some palm oil plantations from PTT Thailand. Now, PTT Thailand is like the equivalent of Petronas in Thailand. It has no business in palm oil. And we understand, and don't quote me on this, PTT Thailand had acquired those plantations during Thaksin's days. It was a way of getting the money out, for
Yep.
if you know what I mean. So eventually, when Thaksin was replaced and PTT Thailand then sat down, this non-core, the palm oil plantations, and they sold it. So these are the genuine sort of reasons, and many times,
Okay.
if you know how to play the game, you understand the motivations. It does help in how you price the deal, what sort of offer price you put across the table.
Okay. So one piece is motivation. Are there other ways to minimize the risk?
Oh, definitely. I think the one which everybody should be paying attention is due diligence. No matter what, whether it's extensive or limited due diligence, please do your due diligence for the commercial, technical, financial, and legal aspects. Don't ever assume that just because you know the target's owners, it's going to be good. No, when it comes to money, everybody thinks the same. All right, so you got to be extremely careful. I'll just tell you of a few examples. The first one, I'll call it Project Timber. Now, my client, when I was in Singapore, I was advising this client. They wanted to look at a forest in Vietnam. A timber concession was there, long concession period. On the photos, the trees look beautiful, mature, ready for felling. But when we visited and had a closer inspection, the story was very, very different. When we looked at the tree trunks, they were riddled with bullets, and
Ooh.
that was all from the days of the Vietnam War. And so you can imagine, if we didn't do proper due diligence, if you had put those tree trunks through the machines and processed the logs, all the machines will be badly damaged, right? So needless to say, client abandoned the deal. I'll cite you another example, Project Highway. I call it Project Highway. This was a transaction which I was advising my client to acquire some toll roads in Harbin, China. Harbin, China, if you're aware, is like the border with Russia. It's as cold as can be. The temperature drops to about minus 24 degrees, Celsius.
Yep. I've been there.
And it's famous for the ice carvings, Harbin.
That's right.
Yeah. So what was important to note that before we departed for Harbin, I did ask my client, "Are you sure you want to go during this winter? It's really harsh, And he says, "Yes, I want to." And I'm glad we did that because although it was brutal that winter, but you could see the traffic volume for those few months was almost close to nothing.
Nothing.
You have to be mindful of the seasons when you're buying something like the toll roads. Obviously, for many of us, when we stay at the equator, we think everything's just normal, steady state, right? But when you talk about seasons, it's very different, So the summer in the Harbin is, of course, fantastic. There's a lot of traffic volume. And the key to that was yeah, please get a traffic consultant to do a study for you. Yeah.
Mm.
Perhaps the last transaction I want to share with you on the aspect of due diligence is Top Glove when they acquired Espion. And that was for quite a sizable amount, 1.4 billion. That's it. They did do some due diligence, but even then they got it quite wrong because once they acquired the company, they found a lot of financial irregularities. It went to court, and eventually it was settled out of court. But the thing about this is, although I advise you, please always do your due diligence. It's never a foolproof guarantee that everything will work out, but you've at least done some part of it to minimize that risk. Yeah.
Mm. Okay, so there's motivation, there's due diligence, there's any others that you want to cover?
Sure. I think for the SME sector, you might have the question, well, what if I don't have the money to engage expensive professionals, the lawyers, the accountants, and so forth? Okay, we do hear you, and I've come across instances like this. At least arm yourself with a corporate lawyer who can help you draft a lot of reps and warranties.
Okay,
To
and
protect
what
you.
and what do those? I mean, just for the SMEs, so that they are maybe can explain that a little bit. Reps and warranties. What do they mean?
Well, if your accounts have been audited and you give a representation that there's no more other litigation, perhaps that
Mm-hmm.
you're aware of, other taxation issues which could hit you, stuff
Derail
like
you.
that.
Yep. Okay,
Some
so just getting guarantees and warranties in place so that if there's ever that the risk is minimized and the risk
Yeah, you
transfers back to
can
the seller.
sue them. Yeah, you can sue them later. Don't let them
Mm.
walk away so easily. Make them
Yep.
really think.
Yep.
Perhaps the other one that I would bring up is earnouts and profit guarantees. While you may have identified a target and you've come to an agreement on the offer price, you could still defer the payment of that offer price and paid in stages,
Mm.
subject to meeting certain profit targets
Guarantees. Yeah.
or
Yep. Yep.
revenue targets over a course of, I don't know, 6, 12, 18 months, to ensure that it really is what it is. And it buys you a little bit more time in case something untoward appears, which you didn't spot at the beginning of the transaction. So
Fantastic.
that's
No,
something
no,
that
that's a good list to think about. In terms of how we can try to minimize the risk. But it begs the question, I guess, including myself. As we are contemplating a couple of acquisitions in a couple of ASEAN countries, is how do we finance this whole thing? I mean, you talked a bit about bank loans earlier on and potential share swaps and so on. What would you recommend in terms of financing acquisitions such as these?
now the best is, of course, if you have some ready cash and you've built up war chest during the good times. But for SMEs, I appreciate that much of your cash is probably going to be plowed back into growing the business. So the availability of any substantial cash in a war chest is not quite there. Then you maybe then have to think about, well, can you go to your friendly bank? I hope it's a friendly bank. I hope you've been
Hopefully, it's still friendly. Yeah.
I hope you've been conducting your account properly and paying all the loans off in time. That's
Right.
another
Right.
route. But
And I
do
think last week we talked. Ravi and I spoke about this. In terms of building relationship and maintaining the
exactly,
relationship with your banker. Yep.
exactly.
Okay. Go ahead.
Bankers never like surprises, so you always need to keep them briefed what you're up to. You got to make sure that whatever is due is paid on time. That's how you cultivate the relationship. Yeah? But I also appreciate that during this climate, banks tend to be a little bit more cautious of who they lend to, how much they lend. Um, the good thing about it is the cost of borrowing now has come down. So it's not all doom and gloom. Assuming you are able to borrow, at least at a cost which has come down. Um, what are the other ways that you can think about raising financing for the acquisition? Um, Equity raising is one thing that you perhaps might want to consider. Do you really need to hold on to 100% of your own company? You may be a SME, but do you need 100%? You start selling some equity, and if you can sell it to maybe even PE funds, this might be something you want to consider. PE funds, and there are many. They love stories where one, if you're short of working capital, they'll help you. Okay. If you spot a good acquisition and you need funds, they can help you too. And it doesn't necessarily mean that when we talk about PE funds, we're only talking about hundreds of millions of dollars. There are many PE funds which focus on much more moderate amounts here. Many do 10 million, 5 million. So, that space, there are quite a few which operate in that segment, the sweet spot for them. Yeah. So that's
Yep.
one way of looking at some of these transactions. And the one that was really huge a few years back was, of course, when the Johor Corporation wanted to privatize QSR and KFC. So they got in the P and CV Capital, helped them because the ticket size is just huge, right?
Yep.
But as I said, many of these principles here on M&A apply equally to SMEs.
As much as it is to big companies. Yep.
You also find PE funds which focus on much smaller amounts. Yeah, you could form consortiums. When I was advising on the takeover of You Help Sing in Singapore, that time Kwek Leng Chan from Malaysia was trying to make a bid for Yoast. He didn't in the end acquire Yoast. That Yoast was finally acquired by the Far East Group in Singapore. But Kwek Leng Chan's group did form a consortium to reduce the risk and to share the ticket costs. So they roped in the Salim Group from Indonesia, one of the biggest Indonesian conglomerates, and the Sembawang Group from Singapore. Each of them had their own motivation too for acquiring Yoast. Kwek Leng Chan wanted Yoast because they had a property in Singapore where the factory was sitting on, which was truly very valuable in Bukit Timah for all those who are familiar with Singapore. Salim, of course, wanted the food and beverage, and Sembawang had some other reasons for it.
Okay. And does the consortium, I guess it also works with SMEs, right? I mean, to partner a couple of SMEs that are part of a value chain and come together and acquire a segment of it. Yep.
Definitely. We often find instances where the target has a collection of businesses in there. Now, you may have an interest in one part of it, not necessarily all of it. So you try to identify parties which could be interested in the bits which you're not wanting to acquire. So yes, it applies equally to SMEs. You can get your fellow SMEs to partner you.
Sorry, yeah, go ahead.
The last point I would make is how else to finance yes, using the shares as currency. When Top Glove, in that example I quoted just now, they acquired Espion. They did use some shares. It's a combination of shares plus cash. 10% was new Top Glove shares were issued. 90% was in cash. Top Glove is never short of $1, as you can see. So, but notwithstanding that, they financed that transaction using part shares. It makes sense sometimes to also use shares as acquisition currency, especially when you have your share price very high already, and when you do issue new shares, then there's minimal dilution to existing shareholders. So these are the sort of ways you can always look towards financing your acquisition. Okay.
And Philip, I think maybe we should bring Ravi back into the fold. Ravi's deep in thought right there, and Ravi, as you listened in to Philip, I thought it was very insightful. In terms of the opportunities the M&A space provides for a lot of organizations, both to the seller and the buyer at this point in time. What are your thoughts, Ravi? On some of the things that Philip shared.
I think first things first. Well done to both of you. You've got a really stimulating discussion going on there. 45 minutes went before we knew it. So it really time's up for the show. But on that note, I think one of the things I was about to share with you guys, and perhaps something that Philip could talk a little bit about, is on one thing that works, I know, during the crisis, and it's not that I like crisis, let's get that right. But
I thought we were going to make that into a big quote. Ravi loves crisis.
No. I think that's Winston Churchill said, let's not let a good crisis go to waste.
But absolutely.
On that note, what we saw when we advised on the Lion deal, we were actually, basically the seller there was the bankers, the de facto owners of the hot rolled oil mill, and LICB came in to buy that asset. Now, it may have been difficult on that balance sheet to go and, for the group to go and raise bank financing, etc. But what we did is we structured the deal that you could pay on a deferred basis. Yeah. So I think that in this time, probably a lot of deals could get done. I mean, look, if you're selling, you get 30% of the money up front or 20% of the money up front. These guys are good for it. It comes to the integrity of the other side, etc. And the way it was structured was, the security remained, etc., and all that remained. Yeah. The existing lenders were the de facto owners, and they actually funded the payment over a period of time, and that's what will, I think, work. That's useful. Yeah.
Very useful.
But Philip, on the other side of it, I think the point that I think always is a concern is this idea that you got this huge idea of goodwill on the balance sheet. I know today intangible assets and companies don't have big assets, and intangible assets are obviously the way forward. But I think in this part of the world, people still see goodwill. Oh God, is that worth anything? When you do an acquisition, you got goodwill on the balance sheet. Yeah. Say you went and bought an IT company, you're going to end up with huge goodwill on your balance sheet, right?
Yes. Yeah. Goodwill is going to be there, especially when you compare it to what they call the fair market value here. You get it your balance sheet. As long as you're able to generate the returns and the cash, the auditors don't make noise of the sustainability of this goodwill. You should be fine. But the question here is, before you even embark on that M&A, have you overpaid for the target? Because that would all go into goodwill too. Now, that's the issue here where we talked about don't chase the deal. If it's looking a bit expensive already, and if there are others who are willing to want to bid it up, you better take a step back, because you really do need to live within your means. And as I said, when you start overpaying, the effects could be far-reaching, and very lasting damage can be done if you find that the returns that you're getting after the acquisition do stack up, and you have as goodwill in the balance sheet needs to be written down. So these are the thoughts that I would have before embarking on the
I think Philip, on that point, it's just not if it's impaired. I think it's the point is, I think one of the problems is when you've got goodwill, the bankers just deduct that from the tangible value and the reserve computation. So it becomes very difficult to borrow money going up. And that's one of the things that I think Roshan will certainly get people who look at this differently. And hopefully we have someone on the show over the next few to talk about intangible assets. It's all about rethinking this balance sheet. I think and not to be absolutely worried if you've got good intangible assets. The biggest companies in the world don't have plant and machinery anymore. You look at the likes of Google, etc. I think it's time to get that education process going just as much. Yeah.
Yes,
And
I think it's a very valid point, Ravi, because there is that awakening now, and we do see it across the causeway. A lot of the Singapore banks are waking up to that and incorporating, when they analyze the credit risk here, they take into consideration now. It's not total acceptance of it, but it's at least heading in the right direction.
Okay, Philip, just to wrap it up, before I get the final thoughts from Ravi, tell us a bit about your final thoughts. I mean, what are your final takeaways that you want to share with our viewers as we wrap up this show?
Right.
Or any piece of advice?
Yes, my advice to you is go back to the basics here. Make sure that that acquisition is really strategic for you. Don't chase the deal. Make sure that you do get your 1 + 1 = 3. Okay.
Sound advice. And Ravi, your final thoughts as we wrap this up?
I think for me, it's look at what's happening. Deals are getting done. I think take it away. It's not impossible to get deals done, and it's that acceptance and time to do the deal. It's happening now, and we've seen that happening in this period. And go out there, look about it. It's part of rethinking a balance sheet. Do I need this asset on my balance sheet, or do I need a new asset on my balance sheet?
Fantastic. Thanks a lot. And of course, the show, if you haven't, we have a rethinking balance sheets and rethinking economics group on necole.app, the Necole community. So if you've missed anything or you want more information, necole.app, check it out. We'll end with a short little video on Necole. But just before we do that, just a quick reminder that our Series A for Leaderonomics with equity crowdfunding with Singapore-based funnel, we close it on March 31st. So if you haven't got your tax deductible, remember all funding for ECF in 2021 is tax deductible. So if you invest money into Leaderonomics, it's completely tax deductible. So with that, I will also leave you with, so there's 5 more days to go, and tinyurl.com/LDRFUNDEL. If you haven't checked it out, check it out. So Ravi, Philip, thank you so much for this. We're going to end with a short little video before we do a final wrap at the end of Necole and the Necole community. So if you have not yet got yourself onto Necole, please remember to go ahead and subscribe to Necole. Go to necole.app, necole.app, and you can download the app from there. With that, that's a wrap for us. 5 more days. Necole's going to be part of one of many technologies that is up for grabs on our Series A. So with that, thank you so much, Ravi. Really appreciate your time. It's been fantastic. I see a bunch of guests, Bruno and others. Apologize to the guests. We didn't have time to take your questions today, but we'll be back next week. And we will definitely have a fantastic guest also to be part and parcel of the show. Philip, thank you so much. You've been outstanding. It was a fantastic conversation. I learned a ton, and I look forward to our next episode of Rethinking Balance Sheets next Friday, 10 a.m. sharp. Ravi, we will see you again next week, Ravi. So look forward to that conversation next week. Goodbye, everyone. Take care.
Bye, everyone.
All the best. Bye-bye, everyone.
Stay safe.
Signing out. Stay safe and have a fabulous, fabulous weekend.